screens up here so we can get going. And just a couple of things before we get started, as far as execution on this, we have Q&A. So as we go through today, just go ahead and pop in the Q&A if you've got any questions. I'll try to hit those questions as we're going through instead of waiting until the end. I think that's probably a better flow. I do hope that we have some participation and that we are able to answer some questions. I guarantee that if one person asks, there's probably 2 or 3 others that really would have asked, but didn't feel like it, or maybe didn't know exactly how to ask. So I think it's good. And my hope is that this becomes more of a conversation as opposed to something that feels like I'm just presenting data, because I think this is one of the better opportunities that are out there. If you are interested in real estate, and understanding syndications opens another world, and we'll talk a little bit more about that. Really, what used to be just a world for the rich to play in, now we have the opportunity for the rest of us to get in here and really invest in things that were out of our reach before. I think that's the key. I think at this point, we'll go ahead and get started. My name is Ismael Reyes. For those of you that don't know me, I am president and founder of MI Real Estate. And I also have another website where I'm condensing all of my material too, because the longer you're in this business, you create entities as you go because you want to isolate them from each other. So you end up with a lot of different entities. So I'm trying to wrap everything around just myself at this point and or our partners in some deals. And that way we're able to capture all of the things that we've got going on in one place. And I should have asked, but can you guys see the presentation?
Sure can.
Okay, perfect. All right. So this presentation is informative only, right? It's to educate, it's to help answer questions. We don't have an actual offering with this presentation, so there really won't be an opportunity for folks to get into some deals. And as we go through some of the structure, the different ways that we can syndicate real estate, you'll understand why this disclaimer is there, because there are rules that have to be followed. This is what we're going to cover today. Essentially, a little background on myself, the companies, and what we've got going on, then go right into an overview of real estate syndications, and then really dive a little bit deeper on some of the phases, because I think there are some of you already that are involved in some deals, and so you've got a good sense of the background of it. This hopefully give you a better idea of all of the things that sort of are encompassed in doing real estate syndication. So again, Ismael Reyes, I've actually retired out of the military as a lieutenant colonel. Even while I was still in the military, I started investing as early as 2005 in real estate, really single family homes. Towards the tail end of my career, I realized that I really enjoyed real estate. Actually, it's always been something that I've loved from when I was young. I started focusing on it as a potential other career, and not as some folks think this is being a real estate agent. It's not. It's real estate investments. A real estate investor. And then the big thing is I'm actually bringing other people along for the ride on these things. We do a lot of the work on our side, and you'll see that during the presentation how that works. And then we bring in others who, for whatever reason, don't have the time nor the inclination to really dig in deep, but they want to reap the benefits of investing in real estate, particularly in multifamily or larger commercial assets. So right now we've got just under 500 properties, or correction, 500 units under management. We sold 4 properties last year. We didn't buy as many, we bought 2, but we did. One of the big things when people ask, what are the things that you did? Some folks focus on the number of units and number of acquisitions. I like to focus on what we actually were able to achieve for investors and ourselves. And essentially, on average, with those 4 properties that were sold, we returned a 60% return on investment to those investors. We had some that were higher, we had some that were lower, but still 60% is pretty darn good, especially when some of these investments were only a year to 2 years long. We like to hold them longer if we can, but sometimes timing dictates. And of course, we had the Fed starting to bump rates and doing some things. So we felt that it was a good time to get out of some assets a little bit earlier and still be able to deliver what we told investors we would. So that's exciting. That's why I do it. This is a win-win game, which is why I like it. When I do well, When we do well, investors do well, and vice versa. So when we talk about real estate syndication, I think especially those that have spent a lot of time doing single family or looking at buying homes, maybe doing those type of investments like I started, I think it's a good way, if you think about it as a creative way to go after properties that where you wouldn't have the capital to do so otherwise. And what I mean is essentially we had one asset last year that was, I think it was $28 million acquisition, right? And so when you have acquisitions that large, it's not going to be an individual, not many in this world that can go ahead and do that, right? And so this creative financing method allows us to get into some deals, like I mentioned, that we wouldn't be able to get in otherwise. And if you're in a single family space, there are other ways that you can do that if you don't have the money to even do the single family, where there are some ways that you can try to get in on some assets at a very low down payment or other ways. So this is just another mechanism, but it fits much better on larger properties because there are additional costs associated with it. So you need the scale in order for it to make sense to do. So this is an overview of syndications. This slide, I'm gonna take a little time on this slide. I think it does have a lot of information. I didn't want to focus this presentation on the why. I was more about the how in this presentation. What is syndication? But I do want to touch on those topics because I think it's important. So obviously, when we talk about real estate syndications, we're talking about, and I mentioned it at the very beginning, we have a group of folks. You have active investors, in this case, we'll call them syndicator. And then you have the other group, which is your passive investors. And so those two entities come together and essentially under another acquisition entity that is created for the sole purpose of buying an asset. And it takes the capital from both, and it takes a lot of the work, most of the work, all of the work really, from the syndication, the active investor side to make this happen. And of course, there is a way that this is divided. Obviously, as I mentioned, it's a win-win. So we'll talk about how normally these things are split up from a return on investment standpoint. So we talked a little bit about what it is. Let's talk a little bit about the tax benefit. We talk about tax advantages. There's two ways. First of all, on a single family side, you also have advantages when you invest in real estate. We take depreciation expense that allows us to take some, regardless of how the property performed, you are still able to deduct a portion of that as a depreciation, as a loss. And you're able to do 27 and a half years. You're doing single family, divide that over, and then you're able to every year just take that depreciation from the property, not the land, but the property itself, and then you're able to get that deduction. When we talk about multifamily, we use what's called a cost segregation study, and what that allows us to do is really segment out all of the pieces of a property into a tighter category. So, for example, appliances. Appliances don't last 27 and a half years. They may last 5 years. So what we do is a company comes in, an engineering company, and they actually do a study where they separate everything into its components, the property. And then you're able to accelerate a lot of that, the depreciation up front. And in fact, a lot of the depreciation, almost in some cases up to 70 to 80% of the entire depreciation that would take you 27 and a half years we're able to capture that in the first year through this cost segregation study. Sometimes a little bit more, sometimes a little bit less. But the idea is if you are concerned about taxable income and if you're a professional and you have high income and you're trying to shield some of that, this is a great way to do it because you're able to accelerate a lot more of the depreciation. If you're an active investor, you can write off 100% of it. If you're a passive investor, according to the IRS, you can write off, and don't quote me, obviously talk to an IRS professional, or a tax professional, usually 20% of that every year, but you can roll over what you're not able to write off as a loss to your personal taxes in the first year. You can roll that over the following years again until you're able to capture that entire amount. So that's obviously from a tax advantage perspective. You do have a capital gains tax when we do exit out of these things. So it's not like you're avoiding it, but you are definitely pushing it to the right. And if you plan it correctly, you're able to really capture the high points and protect from the low points as far as years go and income. So obviously work with a tax professional and somebody that can actually strategize for you to maximize those advantages. I mentioned passive investment, and a lot of people like to use that even when you're doing single family property. I would say that if you're investing in a single family property, It sounds like it's a passive investment, but it really isn't. And we'll go into the details, but essentially the property manager works for you. You're managing the property manager. That means that you are actively involved in that process. And if you're not, you let it go, chances are you're probably not going to get the returns that you could if you took an active role there. Obviously, when you buy right, everything works at that, no matter what. So buying right makes a difference, but you also do have to work. And I remember I tell the story, I've told it a couple of times. When I was still in the military, we were actually in Mexico, working out of the embassy in Mexico. And I remember that we had a single family property near San Antonio that the property manager just quit. And so when the property manager quit, and the reason they quit is the tenant was being a little bit difficult and they just didn't want to deal with it. Guess what? That passive investment was no longer passive. We had to deal with that. So that's why I say in multifamily and in larger acquisitions where you normally would use a syndication structure, we have that covered, and we'll show that in this presentation, how that works. When I talk about lower risk, there's two ways I think it's lower risk. Obviously, if it's a larger asset, you're able to spread the income across multiple units. So just say it's a multifamily complex, 100 apartments in there. You could have 10 to 15 vacancies and you're still receiving a large portion of the rental income. If you were to take that down and you had a fourplex, as you say, if that's what you did, and you had 2 vacancies or 1 vacancy, you're down to either 75 or 50% of your income. So by getting involved in bigger deals, you're actually creating less risk for yourself in your investment. And then the other way, and we'll talk a little bit more on the risk side, through a syndication, all passive investors, any passive investor doesn't have any kind of legal situation that they have to worry about. The legal repercussions of anything that is done wrong at a property essentially stays with the active members of that deal. They're the ones that are potentially going to have legal consequences. And even still, and I know I touched this a little bit, but I think it's a good point to bring it up here. Even still, a lot of the real estate syndications are non-recourse loans. And we'll talk about the different pieces and where money comes from. But non-recourse means that there's no way that if I'm an active investor that I have to worry about some attorney or somebody coming after me personally. They can go after the asset, but they can't go after me personally, and certainly can't go after any of the passive investors. So it's a good way to provide yourself some additional safety there. And then, of course, we know about inflation hedging with real estate. If you just take a look at the news now, I know it feels like with everything that's going on, nothing is quite performing the way it should, but just compare performance of real estate investments to other investments that you have, and you'll see that the numbers may be a little bit lower across the board, but they're a lot lower as it relates to some of the other investments because we are able to use inflation to our advantage. We're able to raise rents as we go and take advantage of that as time goes by. And we talked about economies of scale and why that's important. You're really able to get into bigger deals much more quickly instead of being stuck in smaller deals that a lot of times take more effort than getting into the larger deals, especially if you're a passive investor. Last thing on this slide that I'll touch about, obviously, is the type of syndications that we really are talking about when we talk about real estate. There's 2, and Securities and Exchange Commission has a regulation D, and there's 2 rules under that regulation that really cover syndications, a 506B and a 506C. The 506B syndication is a syndication where non-accredited investors can invest. Up to 35 of those can invest in that. So when I talked about having access to something that used to be only for the rich, using that Rule 506B, we're able to bring in investors that don't qualify as accredited investor. There are some additional rules with that. One is you can't advertise, so you won't see on social media anybody advertising a Rule 506B and an investment. If you have contact or via email or you've talked to folks, then they can shoot you that information directly on those deals, but you won't be able to see that because it's just not, that's the way that the regulation is structured. They really want to prevent folks from potentially being taken advantage of. So they create additional rules and procedures to make sure that those non-accredited investors or sophisticated investors are protected. So that's one. I guess the only other thing on that is you guys can look up the definition of what's accredited versus what's not. In a 506B, you don't necessarily have to prove that you're accredited. So if you feel you're accredited, And you get the information on a deal because a sponsor provided that information to you on a particular offering. You just have to say, I'm accredited as a rule. We don't have to prove that. In other words, if you tell me you're accredited, I don't have to prove whether you are or aren't with a 506B. Obviously, if it's somebody that I know is not anywhere near being accredited, then obviously that becomes an issue of ethicality, right? Of being ethical. And obviously that wouldn't be the case. But if somebody that I know, because clearly I have to know them, is potentially getting into one of my deals and they say they're accredited, I'm not going to be poking around and asking how much money did you make, this, that, and the other. We got to take you at your word on that. With a 506, so the difference with that is anybody, you can see those if you get on LinkedIn and you start connecting with some folks that are involved in real estate, commercial real estate, you'll see these syndications pop up and they'll actually say, here's a syndication, here's how much projected returns are. And you can actually get a full presentation without knowing the person, and just because you saw it, because you can advertise 506Cs because you're not able to take folks that are not accredited, sophisticated investors. You can only take accredited investors. The other piece to that is that for the 506C, a third party has to qualify those accredited investors as being accredited. You need a letter that says such and such, if it's an individual, or this family, Mr. and Mrs., or however that is, qualify as accredited investors. If you're an entity, you have to qualify the entity as accredited entity in order to get into some deals. But then it does have to be proved. I don't prove that. It has to be a third party, by the way that the rules are. Any questions so far? That's a lot on one slide, but I know I wanted to make sure we covered that in detail. I'm looking here at the Q&A. I don't see any questions. So if you have any questions, go ahead and put those in there. Happy to answer. All right. All right. No questions so far. We'll keep rocking and rolling here. And we talked a little bit about in a very general sense about the structure for these things. Let's talk a little bit more about that.
Hey, Ray.
Yes.
Hey, question, Steve here.
Yeah. Hey, Steve. What's up, man?
Hey, you touched on tax benefits. Does the tax benefits, does the investor, do they receive some kind of documentation that they send off to their accounting folks, or is that just for the property, the tax benefits?
Great question. Yes, we send out to every investor what's called the K-1. And that K-1 document is filed with your taxes. The K-1, what's interesting about the K-1, and sometimes it can be a little bit frustrating for investors, is that we essentially have to do the taxes for the asset before we can break up the K-1 into the individual investors based on what you invested, that individual investor's piece of equity into that deal. And so there's a delay because of the fact that you have to file taxes first. Then after you do that, then you provide the K-1. So normally we send those out as early as mid-March, and sometimes it's gone longer. Last year, there was a real issue with accounting days availability, and we actually had to do an extension. It's a free extension. You can essentially you request an extension on your taxes, and the extension goes through the end of September, if I'm not mistaken. It's the one time, and that allowed us to be able to provide that within that time frame for those investors. But it just depends. I think this year, I think it was a COVID thing, and there were a lot of issues related that kind of factored into the delays. But I think there is still that trickle effect of going through the two-stage process to get those K-1s. Does that answer your question, Steve?
Yep. Thank you.
Right. On this slide, we will talk a little bit more. We'll start digging into what is in it for each of the two groups, because you do have the active group and you have the passive investors. I mentioned as far as the liability, there's no liability for the passive investors, but the investors, what they do bring to the table for being a passive investor is they provide the majority of the capital for this deal. So the capital, when I say the majority of the capital, we'll see this on one of the other slides, but essentially a lender will still provide about 70 to 75% of the money, the loan. And you'll see that when we talk about the process. But the other 25 to 30%, plus any kind of repairs that we want to do to the property, some of that will have to be funded by the passive investors. And when we close on these deals, that money has to be there at the table, just as if it was an individual and you were closing on a property and you had a down payment where you have to provide those funds at closing. And so that's important. Obviously, the syndicator group, and when we go into the process, you'll see there is a ton of work that goes into this. And one of the things that sometimes folks forget is that not every deal, most deals that we look at do not result in an actual deal that we bring out to investors, because when we start going through the process, Either they don't qualify from a return on investment perspective. We do have criteria. Want to make sure investors are getting at least 7 to 8 cash on cash and about 15 to 17% return. That's our criteria. It's not something that, that every syndication will do, but that's what we look at when we look at these deals. And obviously location and other things matter as well. But if it doesn't fit that criteria, then we don't continue the process, and any monies that were spent going through that are essentially lost. That's just part of our business. But that is something that is important for investors to know, that there is a lot of work that goes into these things. You ever bought a house, just multiply it, obviously, when you start talking about these larger deals. But the syndicators will put the deal together, will find the investor, will actually create the purchase sale, will sign a purchase sale agreement. In many cases, that initial purchase sale agreement will transfer to another entity, because usually the acquisition entities aren't created until after you find a property. So you assign it to the acquisition entity, LC, at that point. And once you've got that, then you start raising capital on these deals, close on them, and then you manage all the way through exit. So there's a lot that happens on the active side. Passive investors don't have to deal with. I think that's one of the advantages on these if you're busy. Usually the way we break these up as far as who gets what, the investors will get 70% of the distributions, and they'll get 70% of all of the profits. And then the rest of it would go to the syndicators. 30% goes to the syndicators on both the distributions and also on the profits, which is to promote. And then there are some other fees. Obviously, there's an asset management fee. Normally it's 1 to 2%. There's an acquisition fee when we do acquire these. Again, there's a lot of work that has to happen. We don't always close on these things. So we do get a fee anywhere from 2 to 3% of purchase price for these deals. And then on closing, or any kind of, if there's a refinancing that's part of the deal, sometimes there's also a capital transaction fee, which could be 1%. What's important to note, even though there are obviously these fees and folks are getting paid, obviously they're getting paid because there's work that's being done, but it does not impact the return that is provided to investors. So I think that's where it becomes important that investors really have a sense of how these things are underwritten. And we won't talk about underwriting here. That's a whole different subject. But essentially, when someone says, this is your return, these are your projected returns, all of these other fees and all of these other things that go to other folks are already baked into that. And if it isn't, then that's when you really have to question that, because essentially you should be getting there's a deal level return, which is what the return is for the deal. And then there's an investor level return, which is what individual investor would get on that particular deal. Those are key things to look at when you're analyzing these documents, okay? This is just an example using very, very easy figures to show how that works. Again, I mentioned the bank. Normally, this is a notional $1 million acquisition. You get 750K from the bank. Investors provide the other 250. One thing it's important to note, sometimes the syndicators also provide capital. And in fact, a lot of the deals, the lender, or the bank in this case, the lender will require that the active investors put in some of their capital. They essentially want investors to have a skin in the game. Normally it's about 10% of what the total raise that's needed outside of what the bank is providing. And when that happens, the syndicator, actually that money rolls in to the investor side, which is Class A. The Class A investors are called. And then obviously the active investors also have Class B distributions based on the agreement. So in many cases on these, where the active investors are getting money on the passive side and the active side because they provided capital to the deal. In this example, obviously what's showing here is that no money was provided on this deal. Everything came from investors themselves. And so when you break that out, let's say year one, you have a net operating income of $70,000. Out of $70,000, 37.5 goes to the bank, assuming a 5% loan. Now it's been a few months since I created this thing, probably a little bit more as far as the percentage. We're in the 6.5, almost 7 now on these. So you always have to make sure your underwriting is right. But in this case, we go with the 5%. So what remains from that 70 minus 37.5, you multiply that by 70%, and that's the investor return in year one. And then you multiply that by the 30, and that's the 97.50. So that bakes out that way. And then, of course, if you have a sale, in this case, sale in year two, the bank gets their principal back, investors get their principal back. And then the difference between the purchase price and after you take out the bank and you take out the principal, That amount, then you multiply the same structure, right? 70%, 30%. And that's how these numbers come up. But the principle always goes back to investors first before you break out the profits in accordance to that 70-30 split. And I should note that the 70-30 split, that's not a mandatory thing. That's usually a way that these are done, essentially 70-30. I've seen some deals where it's 80-20. I've seen some deals that it's 90-10. And then you have what's called a waterfall structure, which means that as the property performs better, when investors get a certain return level, then the ratios change. There's a lot of different ways to structure what the sponsor group versus the investors get. So that's a deal by deal. So you have to look at each deal to make sure that you understand that. And obviously, when you get these presentations, as we go through the process, that's one of the things that has to be clear in the documentation is how funds are divided. And so there shouldn't be any question about that. So when we put all these together, we talk about that. And in this case, we've got the 30% again for services, not including any capital on that side, 70 on the sponsor side. You have the 70% or $250,000 for the investors. You buy into that entity. The lender actually loans money to that entity because that's actually the owner of it. And that's a 750. And then that entity owns the asset. So that's why you have to create these entities. The longer you're in this business, the more LLCs you are a part of because of the way you structure these to divide them out. Any questions on the structure of how these work? This is simplistic. There are a little bit of nuances to it, but for the most part, these are the major pieces that go here. Any questions on this? See Q&A 1. What do we got here? We got a question that says, how do you find and vet a syndication? Yeah, we'll talk a little bit about that as we go because that's essentially one of the steps to all of these. And we'll talk about how you find them. So that's a good question. That's coming up. All right. All right, so let's talk about the phases. It's coming up right now, actually. So I break it up into these phases. You have essentially formation of the entity, fundraising, prospecting, acquisitions, operations, business plan completion, and then the exit out of the asset. And again, we normally stick in these things about 5 years, syndications 5 to 7 years, because by then you've already accelerated all your tax depreciation. It's not as advantageous to investors to hold it that long any longer because they're not getting that write-off, the passive or active write-off on these. So essentially you sell it, you capture the capital gains on the sale, but then if you invest in another syndication, then that offsets any capital gains that you have to some extent. Again, that's where you really have to get with a tax strategist and make sure that your sales and your purchases are going right along. And essentially, if you sold one, got money from that, ideally you go ahead and turn that and put it right back into another deal. So that way you've got some offsetting taxes there. So we go into each of the portions here. So formation, we talk about formation. We're talking about actual formation of the syndication. And you have to understand there's different ways different features that you have to keep into consideration here. All of this stuff, and one of the big things on the slide that you see says line up service providers. One of the key service providers on this is your SEC attorney, which essentially on the active side, which essentially is taking the business plan that the active investors have on this or the sponsorship team, and they're putting it into the legal framework. And there are differing structures. Sometimes if you can have what's called, and I didn't have it in the initial structure, but there are times where you may have a pref equity partner on some of these deals, especially the larger they get. Sometimes you have the regular investors that are putting in anywhere from $50,000 to $100,000 on these, investing in those, whether they're using cash or they're using self-directed IRAs, solo 401ks, but essentially that money's going in from individual investors, but you may still need a large portion of money on these deals. And so you are able to bring in another group that does fundraising separately, and they have their own rules and their own qualifications to do that allow them to do that legally. And then you can bring that entity in and it'll be part of your syndication as well. So all these things, because that's why the attorney is important, because they will ensure that you stay legal on all these. But there you have the attorney is a big one. You have also, in some cases, one of the biggest expenses that you have to factor in is real estate taxes. So sometimes you want to bring in a tax professional to essentially figure out how to reduce the tax cost on the purchase. And depending on the state, depending on each asset, there may be some advantages to doing that, where you may get a lower tax across that asset as going forward. The larger the property, the more that number is. So any reduction that you can get on the appraisal on the tax side is just less that you have to worry about on the expense side as part of when you own the asset and going through that, it's less to pay. So tax advisor is important. You want to get, obviously you're going to have somebody that does the insurance on these things. That's a significant part of it. So you're laying the foundation with all the folks that you need ahead of time. What you won't see and you shouldn't see is somebody that's trying to figure this stuff out on the fly. And in other words, you need to have your team in place before you really go into and try to get something under contract. There's just not enough time, and it adds another layer of difficulty and frankly risk if you're trying to do these things. Not risk for the passive investors, for the active investors, because one of the things that have to be done at the very beginning in a lot of cases is you have to provide earnest money on these deals when you sign these contracts. So if you may have 60 to 90 days to close on a property, maybe you get an extension, but you better have all that stuff lined up. And that's when it's important that you understand that on the active side before you do it. And passive investors, you should be asking those groups that are offering deals to you, what's your team look like? And they should be able to tell you who's doing what for them, et cetera. And so that you get a little bit more comfort going in on these things. Step two, obviously, is the fundraising. At this point, you may or may not have the property under contract. In some cases, you're able to do some limited discussions with folks about future deals, right? And this is where, especially on a 506B, where you can have non-accredited investors, it's important that this is actually happening, because we have to have a pre-existing relationship with an investor, a non-accredited investor, before they can invest. And so if, let's say we have an offering for a 506B syndication, and it's under contract and we're moving along, and I just happen to meet someone who is a non-accredited investor and has money that they want to invest in the deal, I can't allow them to invest in that deal. It's just that because we did not have that pre-existing relationship. You're working this entire fundraising piece almost in a separate cycle all by itself, no matter where you are in a deal, especially if you're doing multiple syndications, or constantly looking for potential opportunities to invest. Obviously, you've got the equity part, and you also have the loan, which is obviously the larger part of the two, normally 75, up to 75. And in some cases, if there is we call them value add projects, where you're able to push the value of those properties because there's a lot of work that goes into them after you acquire them. And so those value add deals, sometimes they're able to lend you a portion of the capital expenditure on that as well. And what I mean is, if you're gonna repair, you're gonna take out all the old appliances, you're gonna put in new appliances. Well, that's a capital expense. That's not you're not repairing something, you're actually providing something new in there. And those capital expenses can be partially funded by the lender. And the other part, obviously, you have to bring it in from your equity side, from your passive investor partners. The lenders play a huge role in these. And a lot of people, they will tell you that the lender is actually your biggest client. If you're an active investor, your biggest client is that lender, because of the amount of money that they're lending you. And they don't have the protections of the government in many cases in commercial property. So they're very active in underwriting the deals that you're doing and looking at the business plan. That, when I say you, the active investors, they're looking at that business plan carefully. They're doing their own analysis, and they have a whole team of folks. That's their whole work. Their entire work is to make sure that the money is being lent to folks that are going to be able to deliver on these acquisitions. And so, especially when these are a lot of them are non-recourse loans. So in many cases, the lender has its own attorneys that are part of it. They have an entire team of underwriters, and all of that sort of happening as you're working through that acquisition process. And it starts early on. Sometimes you can get terms before you even have deals. You have a sense of what the cost is going to be for the loan, because there's a cost associated, obviously, with having the lender lend you money. Okay, I thought I had another question there. Okay, terms become important in these deals, whether it's a 3-year term of interest only. A lot of times when we doing deals that are value add, you'll have an interest only period, which keeps your price down on your monthly payments of debt, that in turn allow you to then do some of that value add that we're talking about, to then raise the price of that asset, and you can refinance into longer debt with better terms. So there are ways to get into some of these shorter time frame, just to get them in there and do some of that work and really drive the value on these properties. This is to the question about how you go about finding these deals and really prospecting, depending on how you structure this, could be at the very beginning of the cycle. Honestly, it could be one because this is the first time you've done a deal as a sponsor group. You need to create all of these connections before you start doing it. But once you've done a few, you've already got your attorneys lined up. You've already got your tax advisor. You have your insurance folks. So you're not really starting from scratch, and something may come up. And when it does, you very quickly are able to circle the wagons, if you will, and get all the team in place to go after these deals. But a lot of the deals on the commercial side are found through real estate brokers. Real estate brokers are just like on a single family side, on the residential side, they're trying to find sellers. And so they're constantly going after sellers, asking them, hey, when are you going to sell? When are you going to sell? In a lot of cases, if the property that is being sold, the property that's acquired, in many cases, normally we go right back to that same broker for when it's time for us to exit. So they need to make sure they do a good job on the front end, although they're normally representing the seller in these. They want to do a good job because they want these deals to happen. But then if they don't do a good job, then on the back end, they're not going to get the follow-on sale. The other way is, obviously, there's tools out there that allow us to go directly to sellers and ask them, hey, I saw your property on this location. Are you planning on selling anytime soon? And sometimes you're able to get, depending on the tool, you're able to get information. These are paid tools, which we obviously on the sponsor side would have access to. But it tells us when was the loan, how long is the loan. Sometimes if there's any kind of issues with the property, or not the property, but something that would trigger a potential group having to sell sooner rather than later. So if their debt service is too high and they're not making enough income, sometimes that'll show up on these reports. So you can reach out to them and say, hey, obviously, hey, I love this property. I'd love to get in there. You have to do your analysis to make sure the numbers work. But when you get at them that early and you don't have to worry about other folks potentially getting that head start that you have, sometimes you're able to get a good price. And what'll happen is, and happens all on the active side, but there'll be an offering that goes out from brokers to whatever list you sign up for. If you talk to the different brokers, they'll get you on lists, depending on what you're looking at. And there's normally a time very early on where they say, hey, we have a property that's coming up, but there is no time on there associated with when they're going to start taking offers. It's just an initial, send it out there to see who's interested. And you can make an offer on that without having anything else. You can do your own analysis and you can throw that out at that broker. And if the seller takes it, you've really gotten ahead of the rest of the folks. But if you don't, and the deal kind of goes through, at some point, the broker will do a call to offers, and then they'll wait until a certain time and they'll see what offers come in on that date. And then they'll pick. Sometimes it's the best offer. Sometimes it's a group that maybe they're not the best offer, but with a known entity that closes on a ton of deals. But essentially now you've got the competition of everyone else coming in and putting out those bids in. So there are different ways to do that as far as finding these deals. So let's just say you have something you've gotten through the initial process. We did what's called a letter of intent. A letter of intent is a non-binding document that says, hey, I want to buy your property for this much, and here's some basic terms that go along with that. It's sometimes 1 to 2 pages, maybe 3 pages long. And you can agree to those terms. And then once that letter of intent is signed by the seller, then you start going into a purchase and sale agreement negotiation. That's when you really dig in deep, and that's where all the attorneys get involved. It can be a very long process sometimes because essentially this buyer has their own attorneys. You'll have your syndication attorney that's doing your offering memorandum, but you also have an attorney that's going to be transacting for you, making sure, basically the purchase attorney that's making sure that the contract is favorable, that there's nothing in there that's going to be potentially harmful to you as a buyer group. And then, of course, the lender will have their own attorneys because they want to make sure that they're covered. And then obviously the seller also has their own attorney. So this thing can go on for a while as you come through all that. Once you have a agreement in place and you have a due diligence timeframe. Sometimes, especially when it's a seller's market, there may be hard money associated with purchase and sale agreement. In other words, regardless of whether you find something during due diligence, you're going to have to provide hard money that you don't get back if the property, there's something you find out after the fact that makes you want to get out of that deal. And that those are the risks that the active investors take. Certainly the passive investors, their money comes into play when you're at the closing table. So it only gets used for actually closing the deal. There's not that risk associated with the potential earnest money that goes hard or any issues that happen along the way. But so you've got the sale agreement in place, you do your due diligence. The due diligence has a lot of different things that you look at. You're looking at prior performance, you're looking at current rent rolls, you're looking at any kind of, there's a ton of inspections that go in. There's third-party inspections, the normal ones, but then you may have environmental inspections and other inspections that have to be done for these assets. Once that's in the works, at some point you apply for a bank loan. Applications are not free. So there's another cost that may or may not get refunded to the active investors, but you apply for that loan. Normally it's sometimes 1%, it's what the lender will get, but the fee for the application obviously would be lower than that, but it's still, sometimes it's usually, I've seen some as high as over $50,000 to apply, so they can be significant. And so you're going through that process. Once you're a little bit further ahead, you're already working with the lender, things are moving along. You, at that point, are in a position to then assign that contract over to the actual entity that's being created on that private placement memorandum. Then that's where the active and the passive investors get in into that acquisition entity. So you're creating that, but initially it may be my company, MI Real Estate, or the Admirable Group that would actually do the letter of intent that goes on the initial contract, the purchase sale agreement, but it allows me to assign that to that entity. So that's critical when you're obviously in these larger deals. And through this process, at this point, once you've got a property under contract, really once you've gone through the due diligence period and everything seems to have moved along correct and the deal still makes sense and there aren't any red flags, this is when you now are able to start bringing investors into play, and you're able to start raising the capital. And there are tools that we use to essentially bring in that money and put it into an account, an escrow account that we use. And essentially once we're ready to close, and that money then goes from our escrow account into the closing escrow account for the actual closing of the deal. And there's a whole litany of documents that you get as part of that from an investor standpoint. Essentially, there's a package that goes out. You get notified, whether it's through email or maybe you see it on social media. It's a 506C, you're an accredited investor. And then you get access to this package of information, which includes briefings. There's webinars that go along with that. And there's information that's provided and Q&A. And depending on the deal, there may be multiple presentations that happen. Then, of course, you have the private placement memorandum, which is the document that allows you to raise this capital. And it has the entire business plan in there. You know, how we're going to essentially take this asset and provide you that return that we're telling you that we're projecting you're going to get. And then, of course, again, last thing is once we have all the funds, we close. I will highlight one thing. Sometimes we are able to raise capital. So I mentioned that we raise capital, and the capital also includes funds that are used to repair the property. Sometimes you can actually raise capital once the deal is closed. And we've had that several times. And what happens is so long as you have enough money to close, you can continue to raise. Based on the private placement memorandum rules that are set in place, you can raise after closing to capture the rest of those funds, because some of those funds you may not need right away, especially if you're doing, they just say you're repairing units as they become available. In other words, when the leases are up, that unit vacates and you do a renovation there, you wouldn't necessarily need all of the units that you're going to renovate over the life of that business plan right away. So you're able to raise money afterwards. So that's important. And some investors actually like that better. And they can't get into some deals because if they get full before closing, they miss out. But some investors like it better because there's no wait. Essentially, the minute they put their money in, it's already working for them. If you put money in escrow, maybe 30 days, maybe 45 days ahead of time, that money's sitting for a while. And then that can be a disadvantage. Obviously, it's not making you any money for the time it's sitting there. But essentially, that's the risk that you take by not doing that, is that you could be out of a deal. And I have that on most deals where somebody wants to invest and for whatever reason, they waited too long or whatever the case may be, and they can't get into the deal. And 506B deals for non-accredited investors don't happen as often as the 506C deals. So if you're not an accredited investor, you really do want to make sure that you get your money in sooner rather than later, because it's not just about the money. Remember, I mentioned that you can only take 35 non-accredited investors on any particular deal. So we may still need capital, but maybe we've already covered all the 35 non-accredited investors and maybe we can't take anymore. Got a question here. Let's see, Nick or Juan, I'm sorry. Can we get a recording? Yes, I will be providing a recording. I'll post this on my YouTube channel and I will, everyone that registered will get sent you an email that has the link to that. And if you want to get on a separate call at some point, if you got additional questions, obviously feel free to reach out to me on my websites. So you can essentially get on my calendar directly from my websites and we can talk about whatever questions you may have that maybe I'm not covering here. Thank you. Thanks for asking that. These are just some of the documents that on the active side we have to deal with and we're involved in on the front end. Really, if you're a passive investor, it really is this inject towards beyond the due diligence documents where you'll get information. And it'll talk about if the loan is not locked in, because sometimes you're locking in these rates, maybe sometimes a week to 2 weeks, no earlier than a week to 2 weeks before closing. So you can only have a sense of what the rate's going to be for at that point. So you factor that in. And so in your offer memorandum, it'll say, this is the current term sheet that we have. It's at this percent. You're able to talk about these things, but the understanding that there may be some flex a little bit towards the end based on what's happening with the rates themselves. Sometimes you can lock them in earlier. It just depends. Right now, in fact, because of all the Fed doing what it's doing, it was raising rates so much and it was triggering a lot of issues on the lender side. Lenders started locking in rates a lot sooner, given some level of control back to buyer, because essentially these rates are changing so much that if there was no way to lock those in, you could find yourself with an underwriting that no longer makes sense based on your assumptions of what the rate would be. So it's important there. Yeah, from a passive investor side, really, there's not a lot that you have to worry about, but there are things that are happening on the active side. You'll get an investment package, and I mentioned that. Some of them will have all these documents, some of them won't, but you certainly will have the information that tells you what are the rules. Private placement memorandums have to be pretty specific, and it has to tell you how you get paid, when you get paid, what rights that you have as a passive investor in these deals. And if there's any issues, who do you go to get those handled? And essentially those things are covered in there. And so what I tell passive investors when they invest with me is you still need to vet the team that you're gonna be working with. Make sure you ask those questions, you understand the basics about who the team is, how many deals have they done, et cetera. And then you actually should be able to ask them for references of other investors that have invested with them. Because one of the things that we do once we go into the deal, and I'll talk about it on this next slide, obviously we provide reports to investors on a regular basis. We do monthly reporting to investors. Obviously, we'll have, on a lot of deals, we do quarterly distributions. We don't normally do monthly distributions. It's a lot of work to essentially process distributions monthly, but quarterly, we normally send the distributions. The distributions are essentially rental income and other income minus expenses, minus the debt. So whatever is left after you do all that, as I mentioned in that report, then that is broken out in accordance with the agreement of how, who was going to get what cut of it. But yeah, so you want to make sure that you have somebody that is willing to provide you details on what they've done. And they should not have any issues with providing that. If they do, that's a red flag for passive investors. On the operations side, and this is where I mentioned, just talking about the other two things on here, property management and asset management, there's obviously differences between the two. I mentioned up front, if you do single family investing, you may have a property manager that you hire, but that property manager is not the asset manager. In many cases, they don't care whether you are making money or not. That's not their problem. They have a certain amount. They want to make sure that the property's occupied. They want to make sure that everything works, but they're not going to care whether you repair a fridge or buy a new one. What's easier for them? Sometimes that's what they'll recommend, right? I'm not saying they're all bad. That's not true. A lot of good property managers, but you don't quite know, and you still have to manage them on the asset management side, because the asset managers, the main focus of asset management is how do we provide returns to investors, and what's the value of the property? It's that other layer of which is important, obviously, to an investor. It's, yeah, you want to do property management, you want to do all this stuff, but do you have rents at the right rates? What's a long-term projection? Are there any issues that you need to be looking at longer term? Do you need to refinance the property? When do you sell? All these sort of things that that you do analysis for If you're a single or small landlord and you're doing this, you should be doing this for yourself. So that's what I'm saying. It's not something that is not really passive. It does take active work in order to do that. And the more of these single families that you have, the harder it is to sustain that effort, because it becomes a full-time job almost, especially if these properties are not co-located, which is the other advantage of multifamily and a lot of the commercial, that is that they're all in one place. So a lot easier to manage bigger numbers. So it's just something you have to understand. Asset management manages the property manager. And that's something that is something active that ensures that your returns are being looked after. So this slide here talks about business plan completion. And again, depending on what the business plan is, and normally when you get your private placement memorandum and you start getting briefings, you're going to be told, you should be told, what's the business plan? And every deal has its own business plan. How many units are you repairing? Are you renovating units? What are you doing to the exterior? All these things then will lead to, okay, this is what we believe the rents are going to be based on what we're going to do to the property. Sometimes the property may have low rents, below market rents, and you don't really have to do much. All you have to do is bring the property, you clean up the property, and then bring the rents to market. And that may be all that you do on that particular deal. So it just depends, and every deal is a little bit different. But obviously, if you improve things, the reason you improve things is so that you can increase the net operating income for that property. Net operating income on the commercial side is what drives the value. You have cap rates, which essentially you don't control, and the net operating income will give you the value of that property, the actual appraisal value of that property. And then, of course, obviously, so you want to improve some stuff. If that was in your plan, then during this phase, your asset managers are making sure that those things are being done in accordance with the plan. And if there's adjustments that have to be made, and there always are, because you're doing projections sometimes 2 and 3 years ahead of time, that asset management team is working on a regular basis on changing the plan as needed, and not drastic drastic changes, and many times, but sometimes you got to up rents a little bit. Sometimes you got to lower rents a little bit, depending on what's going on. If it's, for example, this last year, right towards the tail end of the year, we had, because of all the naysaying going on and the rates going up, a lot of the young professionals that were getting out of school were not necessarily going out and getting their own apartments and essentially separating from whatever they were doing before, because of the fear associated with all the unknowns with what was going on in the economy. Even though jobs were plentiful and everything was plentiful, you did have inflation. And so that drove a lot of folks to hold tight to what they had. And so a lot of the operators, a lot of the syndicators had to reduce prices a little bit. You want to make sure just a little bit, because we want to make sure we keep occupancy at a reasonable level to ensure that that property continues to function. So this give and take that you have to do on a regular basis, that analysis that an asset management team is looking at. And then, of course, the time of the year as well. It's certainly during winter time, you don't have a lot of people that are looking to move. Holidays, they're spending money and all of that. So sometimes during that time frame, especially in what we call C-class properties, which are properties that are for working class individuals, sometimes, unfortunately, but they have to pick. Are you going to pay rent, or are you going to buy gifts, or doing whatever it is that you got to do? And sometimes those go against each other, and sometimes they'll take the hit and they'll get delayed on their rent for a little bit. So you also have to take that in mind when you're looking at these deals. That's called delinquency, when you have folks that something is causing them not to pay that rent. So all these things have to be factored, and they can tweak the plan a little bit. But you should have a plan that is what's driving you towards the next phase, which is completion, right? Not completion, but exiting out. Whatever your plan was, you have to get, whether we had a property, it was a proof of concept is what we were doing. It was not even a full-blown renovation. We had the property for 13 months. All we wanted to do, 104 unit property, all we wanted to do was prove that the market rents, if we renovated unit to a certain standard, that we would be able to raise rents a certain dollar amount. And essentially, once we did 20 of those units, we were done with our plan. Our plan was never to renovate all of the units. It was only to prove that we could, if we wanted to, renovate all those units and raise income by that much more. So we left that for the buyer. Essentially, look, if you fix these units to this standard, this is the rent that you're going to get. And it wasn't based on any kind of weird analysis. Essentially, these are the rents we're getting now. So it was very easy to prove that. And that was the business plan on that deal. So every business plan is different. Every business plan will have some alternatives. Sometimes it could be a refinance on or around year 3 when most of your renovation should be done. You want to refinance and you provide some of that money back to investors. And now that property, you hold it long-term for another 5 years, maybe a little bit less, maybe a little bit more. But those could be part of the plan. So you either sell or you refi, but you need to make sure you leave yourself enough wiggle room so that if you find yourself in a weird part in the economy, like now, you're not forced to sell. Because the minute you're forced to sell because your loan is up and your refinancing doesn't make sense because the rates are so high, it's not what you factored in, you could find yourself in a bad position on any deal that you've got. So all these things have to be taken into account. And you obviously the investors return, we're trying to provide the best return to investors. And that may mean you take one option versus the other, but nobody's going to do one option. It's going to somehow reduce the returns. Because again, when the returns are lower, they're lower for everybody. So that's never a good thing. All right, those are all the pieces that I had here. I had a few questions. I don't see any more. Are there any questions at this point before we finish this up here? Whoops, actually, there are some more questions. The investment amount, does it vary? All right, so investment amounts do vary depending on the deal size. When I first got started, we were doing properties of 50, I think we had a 56 unit, we had a 59 unit. That was a lot lower total amount that we needed to raise. So we were able to, in some cases, have some investors come in with only $25,000. And at the very tail end on some of these deals, if we only need to finish out the raise, if we only need $75,000 and there's 3 or 4 people that want to do it, we may say, okay, you know what? This is not the minimum, but at this point, we don't need the minimum. We just need less than that. And you're able to bring in certain people at the discretion of the sponsor group. And I normally do that for folks that, that I know that I really want to get into it. They maybe don't have the money that they need to get into bigger, and I'll provide that to them, those opportunities to them. They do get bumped. For example, if somebody comes in and wants to come in with the whole 75, they will bump somebody that wants to do less than the minimum. So those are the 2 things. But in many cases, I try to accommodate folks to bring them and give them an opportunity to get into these deals. So they're definitely eye-opening and life-changing in many cases. Let's see here. Is there a limit for 506c investors? I don't know if the question is if there's a limit of how many you can have. I think that's probably the best way to understand that question. And no, you can have as many accredited investors as you want on these deals. But obviously, most of these looking anywhere from 25, 30, sometimes 50 investors total on these deals, because it does require a lot of work if you have to essentially bring in a lot more. So normally it's about, on most of these deals, anywhere from 50 or so investors. All right. Okay. So how are investors kept informed? I touched on this a little bit. We have, and every group is different. This is why it's important that you get references from people that have already invested with that particular active group. But we do reporting on a monthly basis. I try to do the reports at the end of the month. Sometimes if financials take a little bit longer, sometimes the financials property management can have a little flexibility. There may be some issue with the financials for that month and it may be delayed. So sometimes it'll come in on sometime within that first week of the next month. But we're normally getting financials. So for right now, so in the next couple of days, I'm sending out reports from the December financials because you got to wait until the end of the month. Accountants do what they do and the property manager does what it does. And you won't get that until sometime in January, mid-January, sometimes it's the 3rd week of January before we see as the asset manager, the financials. And if there's something that's wrong with it, when we do our analysis, we'll go back to the property manager. And there may be some changes to that. So it can change a little bit as far as when, but we definitely do monthly. And there are times where out of cycle, we will provide information if it's something significant related to sometimes taxes, what's the status of the K1s. If there's an issue, if we identify up front that there's going to be a problem with distributions on a particular quarter, because things happen. Sometimes we had one property where you had to dig up half the yard because it had a pipe that burst underground, a lot of money. So that money that we had allocated to provide as a distribution we had to use for that asset. I mean, for that repair. And so that threw off our distribution cycle. Doesn't change the returns in the long run when you miss a distribution here or there. It can't happen. And whoever tells you that it can't happen probably hasn't done any of these deals, because they do. Even if there's a pref means you're guaranteed a certain percentage of return every year as a minimum before the active team gets anything. That's called a pref. Even if you have a pref, sometimes that pref gets delayed and we catch up with that pref later on, whether it's in the next few quarter distributions, or sometimes it may be at sale. At sale is when you get that back, but you'll get your return that's guaranteed to you before we would get anything in that case. So sometimes that happens. Those are the times that we would provide some additional information. And of course, those that have invested, I know there's a couple on the call here that have invested with me before, you can reach out to me whenever. And it doesn't take me more than a day or two to get on a call. And I like what I do. This is not like something that, at this stage in my life, it's not something that I must do to survive. I just enjoy real estate, and I enjoy being able to create general wealth for me and for my family and for others to do the same. So that's something that drives me. So I'll get on a call, and sometimes where people are like, okay, Ray, I got to go. It's good talking to you. That's just the way I am. All right, so that's that. Let's see. Okay, I don't see any other questions at this point. Let me make sure. So here's how to get on a syndication with a JV. Okay, so I think when we talk about JV, that's a joint venture. And normally joint ventures, this is another reason why there's so many different entities. For example, like I mentioned, theadmirablegroup.com. If you go to that website, that's a joint venture that I'm in, that we've actually partnered with other active investors to go in and go after assets, because we also need to leverage, in many cases, capital and other resources to be able to go after these things. So it takes a team. It really does. It's just not something that syndication is not something you can do by yourself. It really does require a lot of folks on the active side to make these things work. So we'll create these joint ventures to bring other people to play. And so within my team, I have 5 to 6 partners on any particular deal that are involved in the active management of these deals. And these are all professionals that are doing this. Many of them are doing it full-time. There's a few that don't do it full-time, but they're transitioning from a W-2 job that is related, and then now they're going to be doing this full-time at some point. And so we create these joint ventures, and then that entity then is able to invest as a general partner within that sponsor group. So I guess just to elaborate a little bit more, normally a sponsor group will have several entities within it, and each one of those is considered a general partner of that sponsorship group. So it's almost like you have a joint venture that then becomes part of a syndication of other joint ventures in many cases. And so these can be cumbersome. The important thing with any joint venture is that obviously you define very clearly how they're managed. And so I like managed entities, because you have only a couple of folks that make the decisions. The other partners vote on significant decisions, but you don't want to dilute the decision making to any time you can get 7 or 8 people together, because that may happen once or twice a month, and you may need to do things a lot sooner than that. So the managers of those joint ventures should be active people that have nothing else going on, that can get things done quickly. And on all of these that we do, I like to have somebody on the ground, call them boots on the ground, but essentially it's a partner on the ground that can handle any issues that come up on the ground with the property manager. As I mentioned before, the lender, sometimes the lender is very involved in these deals, and sometimes they want to go out and actually inspect the property. Before they provide you funding, sometimes they'll have the capital expenditure funds in reserve, and they'll only pay you after the work is done. So you got to show them, they come into the property, they inspect it, what you said was going to be done in accordance to that plan did get done before they release those funds out. And sometimes those delays also cause issues with distributions, unfortunately, because we have to work that out with the lender to make sure we've got that right before they allocate money back that we can then free up to go back to investors. But yeah, so we definitely need to have somebody there that can handle these issues. And it can't be somebody who's working full-time somewhere and can only go on the weekends. That just doesn't work. All right. Did I answer the question on a joint venture? I think that was it. Let me see if there's anything else. All right. That's all I see there. My information, if you go to either of those websites on this page, You'll be able to access my calendar and get on any call. I'm happy to answer any questions you may have. I also have, like I said, I'll put this out on a YouTube channel. So if you guys want to refer back to this, I'm happy to provide the slides and provide other resources. I do have for those of you that don't know, I wrote a book as soon as I retired from the military, and my focus was how do I explain to other military members this is a better plan. And in a lot of cases, this passive investing is much better than actually trying to do this actively. And why that is, all of us deploy, we could be in one place this year and next year we may be somewhere else. So being able to passively invest is such a huge advantage when you don't have that issue of trying to manage these assets everywhere. So I wrote this book. If you just type Bluff and you go to Amazon, BLUF, you'll probably find the book. It's under my name. And it's got information, all the information I talked about, and a lot more there that you can reference. And it's 99 cents on Amazon. I left it there. So hopefully those will help you and that this was useful to you. So thank you very much, everybody. You have a good night.